After hitting a low point on March 6, the FTSE NAREIT All-REIT Index is up more than 65% since then. Here to talk a little bit about what's driving that growth is NAREIT Vice President of Research and Industry Information, Brad Case. Brad, so what are the reasons for this fundamental growth?
Well, I think it's a statement of great confidence in the industry from really two sources. One is confidence that the liquidity crisis is over for publicly traded REITs because of the fact that they have access to public equity markets. That's really what separates them from the rest of the commercial real estate investment industry. And the other is confidence that there are going to be tremendous opportunities for both mortgage REITs and equity REITs going forward, and investors want to be in a position to take advantage of the growth that will come with those opportunities.
Is the demand still strong for these?
Sure. I think it's going to remain strong for several years, in fact. As I mentioned, there are two different parts of the opportunity. For mortgage REITs, the opportunity is really right now and in the next few months as mortgage REITs are able to buy up commercial real estate debt assets, especially through TALF. And so many investors want to make sure that they are in a position to take advantage of the opportunities that mortgage REITs will have through TALF. Going forward, you'll see more opportunities on the equity part of the market.
Yeah, you mentioned the equity side. When are we going to see some of these distressed property assets go up on the market and some REITs take advantage of that?
Yeah, that's a good question. For the most part, distressed properties have not yet been on the market. And when I say distressed properties, I really mean perfectly good quality properties owned by distressed sellers. Just at the beginning of August, the MIT Center for Real Estate released its quarterly transactions-based index, which showed the biggest decline in property values in history, and also showed that the transaction volume was only just starting to come back. Now that's significant because as we move forward, when debt maturities come into the market, owners of properties that are highly leveraged and with asset values that are well down from their purchase prices face two options. One of them is to default a mortgage and put that property into the hands of its lender, but the other is to sell the property into a distressed market. And we have started to see a little bit of that movement, but most of it will come in the next 3 to 4 years.
And you mentioned the MIT index, which posted a historically low quarter, and at the beginning you were talking about how the All-REIT index is surging since March. That may be confusing for some investors. What's the difference there?
Well, the difference is that the REIT market, REIT stocks represent the expectations of investors on the growth of REITs going forward. And much of the growth, especially on the equity REIT side, is going to be powered by the opportunity to buy those assets when the debt maturities force those assets into the market, while their asset values are still very low. So equity REITs will be in a position to buy those properties at very good prices going forward. So it's actually a very normal part of the market for equity REIT prices to be going up even while the prices of the properties themselves are going down. In many cases, that part of the market will last for 2.5 to 3 years, during which there's an opportunity for REIT investors to buy REIT stocks while they're going up, while property values are still going down.
Great. Thank you very much, Brad. For REIT.com, I'm Matt Bishar.